What's good, YouTube? In this video, I'm going to go over my A+ ICT entry checklist. This is the same checklist that allowed me to make over 6 figures in prop firm payouts last year, and I'm going to break it down for you guys completely. So by the end of this video, you will know exactly what was behind the trades that allowed me to net 6 figures in profits. So if that sounds good, be sure to stick around and watch this video all the way through to the end. I like to start my trading on the high time frame. I'll go on the high time frame so I can get a high time frame bias, and with that bias, I then go into the markets on the lower time frame and use my A+ ICT entry checklist to confirm alignment within that high time frame narrative. And I highly recommend that you guys use the daily chart for your high time frame analysis. It makes day trading and finding the daily bias so much easier, because you got to think about it. Each candle here, if it's on the daily chart, one candle represents 1 day's worth of trading. So if you can figure out what one daily candle is going to do, you have your bias, and then you just go on the lower time frame, and which is what I do, and use my ICT entry checklist to confirm that price is actually trading within the direction I'm anticipating. Because every component that I use on my ICT entry checklist is designed to be able to tell you guys and give you guys the insight of whether price is actually going to be bullish or bearish by the way it sets up on the lower time frame. So in essence, it is the high time frame bias, but how it sets up on the lower time frame confirms the daily bias. The time of day is super important because it's time and price, and it's time before price. The times at which things happen are far more important than price itself. So by blending a high probability time zone where we anticipate certain things to happen with price and seeing those things happen at that time of day, we create a high probability condition for us to be able to anticipate that price is going to behave in a certain way. For my personal ICT entry checklist, the times of day I like to look for this setup is the London Open and the New York Open. The reason being is that the London Open, which is at 2 p.m. New York time, is designed to start the daily range. So more times out of 10, you're going to see that the London is going to create a high probability low or high of the day, and we can utilize that information by blending with the opening price, which is another component of the checklist, which we're going to go over in a moment, to be able to confirm certain things. And I also like to use the New York Open at 9:30 a.m. New York time. This is another high probability time period where we do see volatility in the market, and we can again utilize the opening price at 9:30 to be able to see the manipulation in price. The second component is the opening price. The opening price helps us see where smart money is going to be buying and selling. And a good rule to remember is that if we're bearish and we're anticipating sales, you just need to remember that smart money sells above the opening price. And if we're bullish and we're anticipating bullishness within the market, you just need to remember that smart money buys below the opening price. The two opening price times I like to use when I'm day trading are the midnight New York opening price, which is at midnight New York time, and the 9:30 a.m. New York opening price. The 9:30 opening price, of course, is what I use then later when I'm trading the AM session, but obviously we're going to cover a bit more details with that as I progress in the video. But both opening prices, I utilize them with the same theory. So it's the move above the opening price. If we're bearish, that indicates manipulation, and it's the move below the opening price. If we're bullish, that indicates to me that we're manipulating from a smart money perspective. The third component to my A+ ICT entry checklist is the opposing move. If I want to be bearish, I'm essentially saying that I want to see price go higher above the opening price before it goes lower. If I'm bullish, I want to see price give me an opposing move lower below the opening price before actually going higher. Now you might be thinking, well, it's all good to anticipate an opposing move, but where are you anticipating this opposing move to trade to before actually anticipating price to turn around? Well, that's very simple. I have two key points of interest that I like to utilize when I'm actually looking for the opposing move. The first one is the fair value gap. So I like to mark out my 15-minute fair value gaps, my hourly fair value gaps, my 4-hour fair value gaps, and my daily fair value gaps. I like to have these on my charts and have them in price as I'm trading. So if I do see an opposing move and I know where my fair value gaps are, I have a high probability price area where I anticipate price to turn around from. So aside from the fair value gaps that I mark out, I like to mark out liquidity pools, because price seeks liquidity and price operates on liquidity within the market. So there are high probability liquidity pools that I like to mark out that I want to see price trade into, either to sweep liquidity, then move in the right direction. And those liquidity pools, if I'm bearish, I'll be marking up my previous day high, my previous 3-day high, my session highs, and any minor highs that are relatively close to where price is currently trading at. If I'm bullish, I'll be looking to mark out my previous day low, my previous 3-day low, my session lows, and any minor lows that are relatively close to where price is currently trading at. And I'm going to be anticipating that opposing move to be a liquidity sweep in those key areas. So I'm going to have these marked out within my chart. So that does more than half the job for you. Just marking out these levels and having them in front of you when you're trading at the right time of day. When you see these things happen, you have a high probability anticipation of where price should trade to as the opposing move. Well, you might be thinking, well, it's all good that you anticipate price to trade into an opposing PD rate, but how do I know that PD rate is going to be respected? Well, that's where this component of my ICT A+ entry checklist comes into play, which is the confirmation. The confirmation, all it is the break of structure towards the intended direction after price has traded into the opposing PD rate. So once price trades into that 15-minute fair value gap, into that hourly fair value gap, into that 4-hour fair value gap, or into that daily fair value gap, or into one of those liquidity pools that are outlined, I want to see price actually break structure towards the intended direction. So for a bearish, for example, I want to see price trade into one of those key areas, and then once it trades into that key area at the right time of day, going above the opening price, I want to see it break structure towards the downside, because obviously I'm bearish. And that break of structure, after price has traded into an opposing PD rate above the opening price and break structure towards the intended direction, that break of structure is a confirmation of the change in the state of delivery, which confirms that price has literally just gone from manipulation, now is in its distribution phase. And in the distribution phase, that's where we then want to participate in price. Now for entries based on my A+ ICT entry checklist, once all these things are in play, I'm literally looking to enter off the FVG that forms within that leg that breaks the structure. So the leg that breaks the structure after price trades into that opposing PD rate, in this example for bearish, you see price trade into that opposing PD rate, break structure to the downside, the fair value gaps that forms within this leg, and I want to see price retrade into that fair value gap. Ideally, I want that fair value gap to be above 50% of this range. So if I pull my Fibonacci from high to low, I'll get 50%. So I want to see that fair value gap be above 50% or at 50%, or if it's the only fair value gap that's formed within this price leg, I'll be looking to trade that fair value gap regardless if it's below 50% or not. Now that we've gone over every component, here's my A+ ICT entry checklist put together, and then after this I'm actually going to go and show you guys some trade examples so you can actually see what it looks like on a chart format. But before we do that, the entire checklist goes as follows. We need time of day, the opening price, the opposing move into the PD array, the confirmation, and then the entry. And here's a short example. If we're anticipating that we're going to be bearish, right? So it can be the London session or the New York session. And the opening price, of course, if we're trading the London session, that's before the New York session starts. So we can't use the 9:30 opening price, but we have the midnight opening price to use if we're trading the London session. If we have using the New York session, we have the benefit of being able to use both opening prices. But I like to primarily use just the 9:30 opening price if I'm trading the New York session. If we're bearish, all we're saying is that we want to see price go higher before it goes lower. Where's it going to go higher into? Well, it's going to go higher into either the fair value gap or a point of liquidity. And I've highlighted to you guys the key liquidity points and the key fair value gaps that I like to look for. Once price trades into that, break structure towards the downside, confirming the change in the state of delivery, confirming that price has literally gone from buying into a sell program and is ready to go into its distribution phase. And that's where we then see price start to trade lower. So we have our time of day, which is the London session. We have the opening price. We have the opposing move. We want to see that at the right time of day into a key PD array. And then after that, we wait for confirmation that price is actually ready to turn around. We get that confirmation by that break of structure. And once we get that break of structure, we then look for that fair value gap that's formed within the leg that breaks the structure to be able to enter off. And that's the entire framework that I like to use to be able to frame high probability trades. And of course, if we're bullish, we have that bullish example as well. We have the opening price, price trades lower, the opposing move, which is the manipulation, trades into a key PD array, which is a point of liquidity or fair value gaps, trades into that opposing PD array, trades higher, breaks structure, confirming the change in the state of delivery, and then we're looking at that fair value gap that forms within the leg that breaks the structure. All right, now here's our first example, and as you can see over here we have our entry checklist. We have time of day, opening price, opposing move, confirmation, and entry. As you can see, for this trade example, we have time of day, which is the London Open. We have the opening price at midnight highlighted here, which is the midnight opening price. We have the opposing move at the right time of day, so at 2 p.m. during the London Open, we see price trade higher. It's already above the opening price, trading into what? Trading into a minor high. This is a 15-minute chart, I believe. I like to look for this setup on the 15-minute or the 5-minute chart. Sometimes I'll go down to the 1 minute if I'm trading in the AM session, but typically I'm looking for this on the 15-minute chart or the 5-minute chart. So we see that opposing move, price at the right time of day goes above a minor high, which is a key liquidity point, and after it sweeps that high, we see price what? Break structure. We see the breaker structure on the swing low here. Price breaks the structure, and within the price leg that breaks the structure, we have that fair value gap forming. And what do we do? Because it's the only fair value gap within the range that breaks the structure, that's the fair value gap we're going to be looking for to enter off of, and price trades into that fair value gap. And as you can see, price immediately sells off. Now you might be thinking, well, what's my target? Well, if you're bearish, you're going to be targeting sell side liquidity. So that's going to be your previous day low, your previous 3 days lows, your previous session lows, and your minor sell side liquidity. And in another example, we have time of day, which is the London Open again. We have our opening price right here. And what do we have? At 2 p.m. again, which is the London Open, we see price give us an opposing move. We see price at the open trade below the opening price, highlighting that manipulation, trades into a 15-minute bullish fair value gap below a minor sell side liquidity, which is the opposing to buy side delivery. And what do you see? Price trades into that, breaks structure here after trading into that key PD array. And within that break of structure leg, we have that fair value gap forming as price breaks structure higher. And what do? We see price retrades into that fair value gap and then delivers on the buy side. So we literally just seen price go from manipulation, and then the break of structure confirms the change in the state of delivery, that price has gone from manipulation to distribution. We literally just wait for price to retrade into that fair value gap, and then we're entering and keying off of that entry. Here again, we have another example, which is the AM session. We have the opening price at 9:30 here. What do we see? We see price trade higher, which is the opposing move, which is against our intended direction. So we see price trade higher into a 5-minute fair value gap, trades into a New York session high, and that is a key liquidity point because that's a session high. And then from trading into that key reference point, we see price break structure lower after trading into that opposing PD array, break structure, creating a fair value gap as it breaks structure. That's the only fair value gap that's created within this price range that breaks this structure here. And then we wait for price to retrade into that fair value gap, and then we see price deliver on the sell side. And in terms of stop loss placement, I know you guys might think, where do I place my stop? Well, you place your stop at the high that forms before the break of structure happens. So it will be this high here, because that's the most recent high that's formed before the break of structure. And that's all I'm doing, guys. I'm just waiting for the right time of day, and I'm utilizing the key components within this checklist that I've shared with you guys in this video to be able to frame out what I'm actually looking for and how the setup should form. Now, I know you guys might be thinking, okay, there might be more details on confirmation and market structure. I have made an entire video on market structure. If you want to go watch that, I'm gonna link it right here. If you guys are a bit confused about high time frame bias and how to find bias, I have made a complete video on how to find bias and completely dedicated to the high time frame. I'm linked that video right here. That's beyond the scope of this video, so go check that video out and you're gonna get a ton of value from it. But guys, I wish there was something more fancy and something more technical to what I do, but that is literally it. I've given you everything that I literally am utilizing when I'm actually looking to frame high probability price move. And you're going to see that once you go in and start backtesting and start looking at pricing this way, and you start using these frameworks to build around price, around what you're anticipating price to do, you're going to see you're going to have a higher understanding of what price is most likely to do next, because you're using the frameworks within how price operates. Now, I hope you guys found a ton of value in this video. I hope I made this video super simple for you guys to understand. If you did, Let me know in the comments below what you found useful and if you found this video valuable. Like, comment, subscribe, and I'll see you guys in the next video.